Okay, guys. I am going to go over with you today what you need to know in order to take the professional bookkeeping certificate test. So, I think that if you understand everything that I go over today, you will do really well on your test. If you do not understand something, what I want you to do is get with me so I can explain it better. I would much rather be in front of you going over this to answer questions, but since I'm not, we'll just wing it here, and hopefully I have everything covered that is imperative for you to know. All right, these are the things we're going to talk about today, and I honestly don't think it's going to take that long to go over this. And I know that you guys know this. I just want to review over it with you and make sure that you are putting together the entire picture of how all of the different things you do in accounting, how they all are put together in one package. So, all right, first thing, cash basis versus accrual. These are the methods of doing accounting. The difference between the two is understanding or recording when revenue and expenses are recognized. That's the difference. It's recorded at different times. So with an accrual basis, that is what you guys learned, is the accrual basis. You record your earnings and your expenses when they happen. With the cash basis, however, you don't record anything until cash is paid or received. So let's look at some examples. On June 8th, you sold merchandise to John Doe. Okay. On June 7th, John Doe paid for his merchandise. So it's very simple. Let's think about this. On June 8th, you sold merchandise to John Doe. Looking at the accrual method here, what would you record for the accrual method? You would put accounts receivable, John Doe would be debited, right? And sales would be credited. Very simple. Your debit, your credit on June 8th. Then on July 7th, if you were using the accrual method, you would, did I say accounts receivable? Yeah. Then you would debit cash and credit accounts payable for the amount, right? That's it. Very simple transaction. That's what you guys learned. However, let's look at the cash basis. If you're on a cash basis system, you only record transactions when the cash is paid or received. So on June 8th, sold merchandise to John Doe. Nothing would be recorded on June 8th, right? If you're on a cash basis. July 7th, John Doe paid for the merchandise he received last month. So you're going to debit cash and credit sales. Accounts receivable is never affected on a cash basis, or accounts payable is never affected. You don't use those accounts because you only record it when you actually have the cash. The reason why GAAP principles, generally accepted accounting procedures, why we use GAAP principles is because you are better able to see how well you're doing at all times. If you don't record the sale until after you get the cash, it's not happening in the month that it happened in. Your records are not completely accurate. That's why as accountants, that's what we want to do. We want to use the accrual basis of accounting. But some people, especially those people who haven't had accounting and they don't really know how to do accounting and or analyze transactions, and they were taught how to use maybe QuickBooks, but they actually don't understand the principles behind it. Then those people are going to probably use the cash basis of accounting. Okay, it's the first thing. Second thing we want to talk about. This is going to be on your test. Bank reconciliation. You guys haven't done bank reconciliation for a couple of years. It's important to do a reconciliation of your cash. By doing that, you know that your records are agreeing with the bank. So, what is the purpose of a bank reconciliation? To make sure that your records agree with the bank. The odds are, if there are errors, that you have made the error instead of the bank, but sometimes the bank does make errors. So it's very important to keep track of this. Also, the bank records fees to your account, and you have to record those. You have to deduct those from your checkbook. You have to deduct them from your cash account in your general ledger. So it is imperative that you go through and you compare what the bank is showing once a month, at the end of every month when you get your statement. Anymore, most people get them. Most businesses get their statements online rather than going through and waiting for them to come in the mail. But so the steps: you're going to have your bank statement and your checkbook. You are going to take and compare all of the numbers on your bank statement and your checkbook. Very easy to transpose numbers. By the way, I just thought of something. Do you remember if I didn't put that in here, but I think this might be on the test. When you have a number that's divisible by 9 that you're off by, remember that that's usually like a slide or transposition. So keep that in mind. If the number's divisible by 9, when you're comparing your checkbook and the bank statement, if the difference is 54, whatever, it's divisible by 9. Is 9 divisible by 54? Anyway, so then it's probably a slide where you moved over the number too far, too little, or you turn two numbers around or transpose them. Okay, so you're going to compare your checkbook to your your check register to your bank statement. You're going to compare the withdrawals, the checks that came out, and you're also you're going to mark off all of them that match. All of the deposits that match. Anything that's left that doesn't have a check mark next to it, those are outstanding. Outstanding means that the check or deposit has not cleared the bank yet. It's not gone through the bank system. So you've written a check to somebody and they put it in their desk drawer and they haven't cashed it. And so you get your bank statement and you've taken it out of your checking account, but it hasn't come out of the bank yet. That is an outstanding deposit. So you're going to have to do something, right? You're going to have to take the balance that the bank statement has, and you're going to have to subtract that check on that to make them equal. They need to equal each other to make sure that you've subtracted correctly, especially when you're doing a manual checking account system or a manual accounting system. Same thing for deposits. Sometimes if you're at the last day of the month, you make a deposit on the last day of the month, more than likely that's not going to show up on your bank statement because the bank probably won't post it till that evening. So then you're going to add into your check register, you're going to add, you're going to subtract your bank things that are on the bank statement. For example, if you have a fee, like an NSF fee or something, you haven't put that in your check register, so you need to subtract that. And then you need to add deposits onto the bank statement and outstanding deposits and subtract outstanding checks from there to make sure and then they should equal once you've done that. There's usually on the back of a bank statement, or you can download like a reconciliation form. You can find those to make sure that they equal, but do it. And if you're using QuickBooks, which most of you guys are going to be doing, then there's, that you can reconcile within QuickBooks itself, right? You guys did that, I'm sure, when you did your certification on that. Okay. Okay, so what should I do when checks I wrote still haven't cleared after months? And so you have you're like every month you keep having, they're never clear. They never clear the bank. They never get to the bank. Check with the payee. Check with the person you wrote the check to. Figure out if they got the check, if they, whatever, right? Determine if the check should be voided. If the checks are voided, you should probably put a stop payment on those with the bank. The bank will charge you a little fee, but then you won't have to worry about them coming through a year later and not having enough money in your account or something. Okay. All right. Hopefully you guys are good with that. Let's go to the next thing. Account balances. What's the normal balance of each of these accounts? Asset, expense, liabilities, revenue. Asset, what you own. Liabilities, what you owe. Assets minus what you owe, assets minus liabilities equals the value of your company, which is the equity, right? So what is the relationship of these accounts with the equity of a business? Assets minus liabilities equal the equity. What you own minus what you owe equals the equity or the value of the business. Expense and revenue, those and withdrawals, those are just part of your equity. What you do is you separate out your equity throughout the month to create your income statement to know how much money you earned, hopefully not lost, but what your net income was for the month. And that's where these two numbers come in. They're temporary accounts of this, which is your capital or stockholders' equity, depending upon the makeup of your company. We'll talk more about this in a little bit. Okay, so here we go. Assets are on the left. They have a debit balance, so they increase on the left. Liabilities and equity are on the right. Left has to equal the right at all times. Debits have to equal credits. Since these are on the right, they increase on the right. Equity increases on the right. What you own minus what you owe equals your net worth. The value of your company is right here. Throughout the month, you're going to have things that affect the value of your business. These are the things that affect the value of your business. So, during the month, you are going to have expenses. Remember that equity has a credit balance. They increase on the right. Expenses decrease the value of your company. So expenses have a debit balance because they decrease equity. So you always debit expenses. Withdrawals, how much you take out of your company, decrease the value of your company, decrease equity. Since equity has a credit, you're going to debit withdrawals to decrease the equity. If you make an investment in the company, it increases the value of your company. Therefore, your investments, you always credit investments. They increase the equity of the company. Same thing. Oh, this says investment. This means this should be not be investment, it should be revenue. Okay, I meant one of these is investments, one of these is revenue. I need to fix that. So revenue, making a sale, increases your profit. That increases the value of your company. And so revenue has a credit balance. Remember that these four are that this is just done throughout the month. And then you use this information from these accounts throughout the month to create your income statement to show, actually, it's just your expenses and your revenue over here. Those two. These two don't affect, they affect the equity, but they don't affect your net income. That's why these two aren't included. They're temporary accounts, but they're not included on the balance or your income statement because they don't affect how much money you've earned. Your revenue and your expenses affect how much money you've earned for the month. But all of these, all four of them, affect the equity. So you're going to, throughout the month or your fiscal period, you're going to figure out, add up your revenue, your revenue, subtract your expenses to get your net income, right? Then you're going to zero out all of these accounts at the end of the month and put them into your capital account or your equity or your retained earnings account if you're a corporation. Okay. I'm going to have to fix this. Okay. Let's talk about inventory. Perpetual versus periodic. You learn the periodic system. Periodic is a manual system. So QuickBooks is a perpetual system. Doing everything by hand is a periodic system. So it's different how you do your records. Because in a periodic system, you're going to have to count your inventory all the time and make sure to get a value of what your inventory is. Perpetual, every time you receive merchandise, it goes in to merchandise inventory. Every time you sell it, it goes out of merchandise inventory. It always goes to the merchandise inventory account. There's not even a purchases account with the perpetual system, with the point of sale system. With the periodic system, periodic inventory, you have to count it and then make an adjustment to your merchandise inventory to fix it for loss or for income, which is very rare, but usually it's loss. So let's look at the two types of inventory. When you put the value on your inventory. Merchandise inventory account has the value of what you have in your inventory. So FIFO, first in, first out, LIFO, last in, first out. So let's just look at a little scenario here. January, you received 100 items. They were $100 a piece. February, you received 120 of the same item, but you had to pay $122 a piece. And then March, you received 125 more items and you paid $118 per each one. Now, here we are, and we want to figure out what the value is of our inventory. Let's say that we have 200 units left in inventory. We've sold everything but 200. We have 200 left. So with first in, first out, this comes in, this goes out first. So what you have left is here, right? So with first in, first out, if we have 200 items left, we have all of these, 125, Let's calculate this. Bring up my calculator. Okay. The value of what I have left on hand is going to be 118 times 125, right? 118 times 125. Let me add that into the memory. And then if it's only going to be 75 of these at 122, right? 75 times 122. Add that to memory. So the value of my merchandise that I have left, if I only have 200 items left, is 23,900 is the value, right? That is with first in, first out. First in is going to be the first to sell out. These are the value of the first ones that sell. Last in, first out. Then you're going to take, then what's left, you're going to have 100 times 100 plus 120 of, no, 100 of these. 100 times 122. So you're going to use these two, all of this, and then 100 of these for last in, first out. This one you use all of this plus 100 of this. 100 of this is going to be the same, but it depends upon. So that's going to give you the value that's left on hand, right? So that's how to figure the last units that you have. That's the value of your merchandise inventory, what we just did. This is the value of your merchandise inventory that you have left if you're using a FIFO system when you go in to calculate when you go to make an adjusting entry in your merchandise inventory. So what is the cost of goods sold for 400 units? The cost of goods sold. So first in, first out. Oh, 400. Okay, that's not a very good scenario because that would be all of it, right? But let's say that this number here was 200. Let's go to 200 here. The cost of goods for 200 is going to be this number for first in, first out. This number plus 100 of these would be the cost of goods. Last in, first out would be the cost of goods that you sold, would be the opposite. So it's just going to be the opposite way. I hope that makes sense to you guys. If it does not, just let me know. Okay, make sure you understand the steps in the accounting cycle. It's logical. You're going to get the source documents, your checks, your invoices, if you don't have one, you're going to use a memo, right? Your sales invoice, your purchases invoices. So analyze those source documents, record them in your journal, and then you're going to post them to the general and your subsidiary ledgers. Then you prepare an unadjusted trial balance. The purpose of the trial balance is to make sure that your debits equal your credits. So this trial balance, you're going to take all of your accounts that you have in your ledger, in your general ledger, you're going to write those down. You're going to make sure debits equal credits. Then, you guys didn't do a worksheet. It's been a couple years since you did a worksheet. You don't have to do a worksheet, but because what you guys did is we skipped this when we did the corporation and we went right to adjustments. But it's easier when you're learning to use a worksheet because you have those columns that say adjustments. And then you move everything over into your, if you remember what a worksheet looks like, you move everything over to the income statement columns and the balance sheet columns so that you can prepare those easier when you're first learning how to do this. But so when you make your trial balance, you're going to go through that trial balance. You're going to look at all your accounts. You're going to say, okay, here's all my asset accounts. You're going to have your liability, your equity accounts. Debits should equal credits, but those asset accounts, though, they might not be accurate. That's why you make your adjustments. You have, because we're using an accrual-based system. You want everything that happens during that period to be recorded, that period, so that your records are accurate. So you're going to prepare adjustments. You want to look at those. Okay, when you purchased your supplies, the supply shows that the value of your supplies is $500. However, you know that you've been using a heck of a lot of supplies. That value that you are showing in your books is not accurate anymore. So you need to make an adjustment. So then you're going to prepare your adjustments and then make your financial statements. Remember, the whole goal of this cycle is to prepare financial statements and then close them out, close out all of your temporary accounts, and get ready for the next period. The whole goal is to make financial statements because your goal as an accountant or in finance is to analyze those financial statements and determine, to compare them, to do a comparative analysis. You guys did that this last year. Compare those, see what's changed. Why has it changed? Has it changed for the good? Is it positive or is it a negative change? If it's positive, you want to keep doing it. You need to analyze them, figure out what you've done and what needs to change if you're not making the profit. Remember doing all of your ratios, doing that ratio analysis to determine whether it's a positive trend or a negative trend. That's what you're doing here. But the whole goal in doing all of these is to get to here, these financial statements, so that you can tell how well you're doing and make changes. Okay? So once you prepare those financial statements, you do your closing entries, you close out your temporary accounts, your revenue, expenses, and your withdrawals, close them back into your capital or your retained earnings if you're a corporation, put them in there, do another trial balance to make sure that everything is still in balance, and then get ready to start this over again. Okay? So have an idea. This is the ultimate goal right here. There's a whole bunch of different accounts that are inaccurate, and you want to make those accurate. That's why you do those adjustments. Okay. So here's some of the things that you adjust. Some of the accounts that you adjust, depending upon your company, could be more, there could be less. But the ones that you learned how to adjust supplies. Insurance, you pay for it up front, but then you use part of it, so you have to adjust it to make it accurate. The purpose of doing adjusting entries is to make your books accurate. Allowance for uncollectible accounts, customers that you know, a percentage of the accounts that you have won't pay you back, so you make an adjustment. Merchandise inventory, if you're on a perpetual inventory, you don't do an adjustment for this. But if you're on a periodic inventory, then you have to do a physical count and make an adjustment in your merchandise inventory. Depreciation, what you paid for your computer a couple years ago, it's not worth the same amount today. So you have to make an adjustment to show on your books so your books are accurate. Interest receivable from your customers that maybe with your notes receivable, if you remember that, like your customers, or they're going to pay you money and you might not have gotten that money, but the period that it's earned, you need to record the period that it's earned. Your income tax, you know that you have a net income before income tax, you have your net income after you have to pay your income tax. But on all of the money that you earn, I don't think we did an adjustment for this one, but the money that you earn, you're going to have to pay income tax on it. So unless you make an adjustment for your income tax, what you have to pay on it for that period, then the amount of money you earned is not accurate, right? Any asset account that's not accurate, you need to make an adjustment for it so that you can analyze those financial statements better. If they're not accurate, what good is it going to do? You don't know what's going on. Okay. All right. Stockholders' equity accounts. Which three accounts are classified as stockholders' equity? You guys remember this? This one, this one, this one. There's three of them. You have 6 listed here. You guys look at these. Think about it yourself before I go give you the answers. Capital stock. You might also record it, put it down as the title common stock or whatever. But okay, yes. Remember, this is an equity account. It's a stockholders' equity account. This is the amount of money that you receive from your stockholders. It's an investment. Remember, this is an investment. Capital stock or common stock is the investment account. So when you sell stock in your company, the stockholders pay money. It increases capital stock with a credit because it's increasing the value of the company, so it's credited, and the cash is debited, which is an asset that's debited. So yes, this is one of them. Due to owners, that's not an account. Deferred revenue, you never learned that. Accounts payable, it's a liability, that's not it. Dividends, the D, drawing dividends, this is what you pay your stockholders for their investments, okay? You pay them based on how much you've earned. The board of directors decides whether to pay out dividends or not. So this is drawing. So this decreases equity, so it has a debit, right? You're going to debit dividends and then credit your cash because you're going to pay it. Actually, what you learned is crediting dividends payable, and then when you actually go to pay it, you're going to debit dividends payable and credit cash. And retained earnings, this is the big one. This is like capital and a sole proprietorship. Retained earnings is the value of the company. Whenever you do your closing entries and you close out your revenue and expenses after you've completed your financial statements and your net income your income statement specifically, then you're going to zero those accounts out, the temporary accounts, and put them into retained earnings. This is the most important account for a corporation. A few more vocabulary. Par value is the value assigned to stock when it's originally issued. So when you originally issue this capital stock, let's say that you issue 10,000 shares of stock at $10 par value a piece. Okay. So the value that's printed on the stock is $10. That's the par value that's printed on that stock. However, when the value of that stock increases, then people will pay more than the par value. The amount that they pay in addition to par value is called it's called the paid in capital. It's the amount over this. And that's also equity in the company, the paid in capital, when they pay more than this. So you never learned this, but the paid in capital is also another account that is in the stockholders' equity. And it's going to, of course, increase the value of the company. So it's going to be a credit balance. So let's say that let's say that the par value of the stock is $10, but you sold stock for $50 a piece. Then the $10 capital stock would be credited, and paid in capital would also be credited for $40. and then cash would be debited for 50. Does that make sense? Debit cash for 50, credit capital stock for 10, and credit paid in capital for 40. If you get $50, that means your company is doing really well, right? You're making 5 times the value of what you originally thought you would for that stock in the company. I know that there's a scenario like this on your test with this in there. Okay. Okay, some other things that you need to be aware of. When you are an accountant, it's an esteemed profession. Accountants and bookkeepers need to show professionalism, or else they will no longer have a job, nor will they get any clients. They have to be confidential. You guys learn this from your tax preparation anyway. And I know that you guys, and this is pretty much logical, but I know you'll have something on your test about it. So you need to be ethical. You need to use ethical conduct in what you do. You do, even if you know rules around cheating the government, cheating your clients, you do not do that. If you were to do that and someone finds out, you would no longer have a business. You need to be competent in the work that you do. You don't just make some decision and just go with it because you think it's right. You need to know that you're doing it correctly and that you're giving your customer the best service that they can get. You need to have integrity. You need to be, I already said ethical decision making, continual learning. As an accountant and a bookkeeper, you will have to keep up to date all the time. You're going to continually educate yourself. You make a lot of money for it too, by the way. So it's really good. So, okay. Financial statements. Here's some of the financial statements. Balance sheet. What accounts are on a balance sheet? Permanent accounts. Assets, liabilities, and equity. Equity is permanent. You take the temporary accounts and put them into the equity account at the end of the fiscal period. Income statement has your revenue and expenses. Statement of owners or stockholders' equity just shows how the account has changed over a period of time. For example, you have this is your you've sold this much stock in the company. You've paid out this much in dividends. It just shows the change over that period of time, the beginning and what you ended up with as the value in this account, your revenue and your expenses, which would be summarized in your net income or your net loss, would also show up on your stockholders statement of stockholders equity or the statement of owner's equity. The purpose of each, the balance sheet, is to show the value of the company with the equity. It's also to make sure that everything is in balance. Your assets equals your liability plus owner's equity. The income statement is to show your net income or your net loss for the period of time, for that fiscal period. And your statement of owners or stockholders equity is to show the change of the equity account over that fiscal period. Remember that this one and this one, since they have temporary accounts on them, those are for a period of time, for the month ended, for the quarter ended, whatever, these two. But balance sheet is for a point in time. It's on a specific date. It's on the end of the month, end of the quarter, end of the year, one date, January 31, December 31. Okay. That is also on your test. Here's an example of payroll. When you pay your employees, remember these two reports that you guys learned are easy to get confused which one is which. Remember that the employee earnings record is for the employee only. It has only the employee. Right here, Lyric Crosby's the employee. It has the only one employee, how much they've earned, and what their accumulated pay has been for the year. Whereas a payroll register lists all the employees and the totals for each employee. For all, I mean, not each, for all of them together. Okay. This is so you can keep track of the total earnings. Remember, you don't have to pay taxes on everything if they've reached the maximum amount that are taxable. Okay. So know the difference between these two. Okay. We're getting there. To the miscellaneous. You're a bookkeeper for a retailer that uses a perpetual accounting system. The retailer purchases 10 items for sale, 100 each, due in 30 days. What is debited and what is credited? Okay. Remember, perpetual, you don't use the account purchases. It keeps you keep a running balance in the merchandise inventory account. So you purchase 10 items for resale, 100 each. So merchandise inventory is for resale. So you're going to debit merchandise inventory. You don't owe money. You're not debiting accounts payable. It's not a liability. You're not receiving cash. You're not buying equipment. So it's merchandise inventory is debited, due in 30 days. So what's credited? Accounts payable. Debit merchandise inventory, credit accounts payable. You are going to have several transactions on your test that you need to analyze the transaction and record your debit and credit part. What is a general ledger? General ledger, all the accounts. It's like your chart of accounts laid out. Every account that you have in your chart of accounts is put together in a ledger. You keep a running balance of each debit and each credit for each individual account in your chart of accounts in the general ledger. What is a journal? A journal is used to record a transaction. General journal is what you first learned, but then we divided it up into special journals. The reason in a manual system that you use special journals is to make it easier to record transactions. You don't have to write as much. Are special journals then used in a point of sale system, in QuickBooks, in a computerized accounting system? No, they are not. You guys know that. This is only in a manual accounting system. It automatically does it for you. It's so much easier, as you guys well know how much easier it is using a computerized accounting system. What is the difference between a transaction and a ledger? Transaction is recorded in your journal, right? Your ledger is where you post to post the transactions into the ledger, the general ledger. You also post to your subsidiary ledgers for your accounts payable and your accounts receivable ledger that you learned. What is the relationship between the chart of accounts and the general ledger? The general ledger lists all of the accounts from the chart of accounts. Chart of accounts has everything listed there. What is meant by gross? Gross is the total before deductions. Net is the amount after deductions, like in your payroll. The gross earnings are the total earnings that your employees earn. Then you take the deductions out for medical, dental, 401k. What's left, what they actually get, is the net amount. What is book? Book value is the total minus the contra accounts. So you have your depreciation, your equipment. The value of your equipment is what you paid for it. That is the original value. But the contra account is your accumulated depreciation. So the original cost minus accumulated depreciation, or the contra account, gives you the book value. The book value is similar to the net amount, right? It's after the deduction, after the decrease in value. Okay, why are adjusting entries made? Well, to make the balances correct. We talked about that a little bit ago, right? To make those asset accounts are going to be accurate. What are typical accounts that are adjusted? Those are asset accounts. Asset accounts are adjusted. You want to make them accurate. Current versus long-term assets. Remember, current assets are the anything that you will have less than a year. Long-term assets are more than a year. I think that's on there too. Make sure also that the purchase price, let's say that you buy in your inventory, an item costs $10, but you have to pay $1 to get it here. Do you record it, the value of it, as $10 or $11? You record it as 11 because that's what it costs. That's the actual cost to get it to you. Okay, so merchandise needs to include the shipping cost too. A building includes the cost of building it too. So you have to pay construction workers. Okay, so the building, let's say that you buy a metal building. That metal building costs $500,000. You're not going to debit your long-term asset of building for $500,000. You also had to pay somebody to install it, to put it in. So the total amount they charge you $250,000. So your building is debited for $750,000, not what the actual cost, just the building itself. Everything to use for it to be usable. Okay. Oh my goodness. Here we are. You got this, you guys. If you understood what I went over with you today, I have no doubt you're going to pass this test. All right, so go through this, and you guys let me know if you have any questions as you're going through this, okay? All right, good luck. I'll be reaching out to each of you to take your test.